You enter a trade and place a stop loss below support. Moments later, the market drops to hit your specific price before reversing into profit. These targeted place moves are calculated actions by algorithmic trading systems designed to fill large-scale positions. We are breaking down the map these institutions use to locate and absorb retail orders. You will learn a 3-step protocol, the Golden Zone method, to align entries with institutional volume. Mastering the structure of liquidity changes how you read a chart, moving from reacting to price to identifying where the big players are active. Large players face a logistical hurdle. If an institution tries to buy 100,000 shares at market price, they will exhaust every available seller on the way up, causing slippage that destroys their average cost. To fill a position of that scale, they need liquidity, a high-density cluster of opposing orders waiting at a specific price point. When a retail trader goes long, their stop loss becomes an automated sell order. A cluster of these stops provides the volume institutions need to fill massive buy blocks. Because these unexecuted orders are visible, algorithms calculate precise trajectories directly into these high-volume clusters. To defend against this, you must stop broadcasting your exit points. Avoid placing obvious, tight, hard stop losses directly into the broker's terminal. Reducing your position size allows you to use wider, unconventional stops or mental stops that don't appear as a target on the order book. Standard retail tools can be tracked on the book. Survival depends on making your exit points harder for an algorithm to map. On a chart, these liquidity pools are easy to locate. They sit just above recent swing highs and just below recent swing lows. Retail traders often experience a fake-out because they enter the market the moment price breaches these obvious technical levels. To avoid this, we categorize breakouts into 2 distinct events, the liquidity swap and the liquidity sweep. In a liquidity swap, price crosses resistance, consolidates briefly, and continues moving forcefully, indicating a genuine shift in structure. A liquidity sweep looks different. Price dips below support to absorb resting orders before aggressively reversing. This is the institutional trap. The sweep is your confirmation. It shows that large players have finished absorbing retail volume and are ready to move price in the opposite direction. Waiting for the sweep to conclude ensures you are trading with the momentum of the algorithms, rather than the anxiety of retail traders. We can systemize this entry using a 3-step plan. We'll use a live Bitcoin chart to demonstrate the execution. Step 1. Draw a horizontal line at a recent swing low. Step 2. Wait for price to sweep below, then close above it. Step 3. Anchor a Fibonacci tool from the sweep to the new high, highlighting the golden zone. The entry trigger occurs when the price retests and falls back into this shaded zone. Place your stop loss below the sweep wick and set your target to a 1-to-2 risk-to-reward ratio. This sequence provides a checklist for the trade, replacing subjective intuition with a technical protocol based on institutional behavior. This is the outcome. The price reacts to the golden zone parameters and moves upward to hit the target line. This strategy replaces the urge to guess during a breakout with a requirement to wait for a confirmed institutional move. Practice identifying these sweeps and marking the zones on a demo account. The goal is to make the pattern recognition process second nature. If you found this breakdown useful, like the video and share it with someone struggling with stop hunts. Comment the asset you're watching next and subscribe for more FINOX strategies.